With 4imprint, finding the right promo products can be easy. They call it 4imprint Certainty, which means you get free samples, expert help, art assistance, and their assurance your logo looks great. 4imprint offers thousands of options to choose from, including branded apparel, drinkware, outdoor, and more. And it's backed by their 360-degree guarantee. That's 4imprint's promise that your order will be packed with care and delivered on time. Need your order faster? 4imprint offers quick turnaround options, too. Visit 4imprint.com to explore. 4imprint, for certain.
At CES, Michael McDermott, EVP of Samsung, spoke with Bloomberg Media Studios about what the company calls its next AI chapter, your companion to AI living.
It's a shift from AI as a feature to AI as a trusted partner in everyday life.
Welcome to Inside Active, a podcast about active managers that goes beyond sound bites and headlines and looks deeper into their processes, challenges, and philosophies in security selection. I'm David Cohne. I lead mutual fund and active research at Bloomberg Intelligence. Today, my co-host is Athanasios Psarofagis, ETF analyst at Bloomberg Intelligence. Athan, thank you for being my co-host today.
Hey, yeah, thanks for having me. Happy New Year, if we're still allowed to say that. I don't know.
Definitely.
I don't know whether we have to stop saying it.
We got like a week or so left. I think we're okay. So since it's the start of the new year, I thought we could discuss active ETFs. So let's bring our guest on. Todd Rosenbluth is head of research at TMX VettaFi and is obviously someone who is no stranger to ETFs. Todd, thank you for joining us today.
It's a pleasure to be here. And yeah, I'll say Happy New Year to you, both of you.
Great. So over the past few years, we've seen active ETFs go from emerging to mainstream. From your vantage point, where are we in the life cycle right now?
I think it's still very early days. I believe year-end data shows that active ETFs are roughly 12% of total ETF assets. Now, that's significantly higher than it was 3-5 years ago, but I still think there's a lot of room for growth. I think there's going to be growth. We'll talk about more as these larger asset managers have brought their best and their brightest into the ETF marketplace, as we've seen active ETFs evolve into and see demand more for the security selection, a discretionary approach to building portfolios from a stock or bond standpoint. So I still think this is early days. I think we're going to be in the next 5 years, we'll see that percentage increase into the higher teens and then perhaps more stabilize over time.
Well, what surprised you most about active ETFs last year?
Well, I'm just really excited about the success we saw from the firms that I think about with active ETFs. So we saw Capital Group cross $100 billion in active ETFs. In fact, that's the only type of ETFs that they offer. And they entered the marketplace just over 3 years ago. At the time, or roughly at the time that they crossed $100 billion, they're coming up on their 4-year anniversary. Firms like T. Rowe Price saw its asset base nearly double in overall from a flow standpoint because the firm got greater commitment and greater focus on active ETFs. And there's a whole bunch of other firms. So the fact that we saw what I and perhaps many other people think of as active ETFs, as stock and bond picking, see demand, that really excited me.
Okay. And, active management is really my specialty. And so I really have to ask, do you think the flows last year were driven more by market conditions, or is it kind of, a renewed confidence in active management?
So I think the flows were close to $500 billion that went into active ETFs. I think it matters how we classify something into an active ETF and what is and what isn't. So that's why I'm using close to, because I've seen data sources that where it's above that number and below that number. I think this is people having greater confidence in active ETFs. And so I think of this as more of a strategic opportunity as opposed to tactical moves. The market wasn't that volatile, which would make you want to turn to active management. In general, it went up, and when the market goes up, and it's okay to invest in an index-based approach. If you're choosing active, then you're choosing it for confidence. But I guess I'll hedge my own bet a little bit. The fact that we saw growing demand and even stronger demand for active fixed income ETFs We did have a more challenging fixed income environment. We saw the Fed renew its cutting of interest rates in the fourth quarter of 2025. And people are going to turn to active managers when they're unsure about what's going to happen in the bond market. We've got the Trump administration talking about replacing the Fed chair, and it's not clear who that's going to be. If you don't know what's the next move from the Fed is going to be in 2026 or heading into 2026, working with a Rick Reeder of BlackRock, working with the team at DoubleLine that are experts within the active fixed income space, I think makes a lot of sense. So I guess I'll hedge my bet in terms of where it was more tactical, perhaps from a fixed income standpoint, but what I'm seeing in the equity space gives me confidence that this is more strategic.
No, it makes sense. And our ETF, or I should say, active ETFs, are we still in land grab mode, or are we kind of starting to enter consolidation phase?
So I think a lot of what we're seeing is that people are moving. So people have been moving from active mutual funds into index-based ETFs. That's a trend that's been going on for years. I think some of what's happening is people are moving from active mutual funds into active ETFs, and this from the same firms. And it's not necessarily a clear one for one. I think I've seen your research out there that shows that a firm that offers both active ETFs and active mutual funds, that they're bleeding assets on the mutual fund side and they're growing assets, if that's the right way of using that analogy, on the ETF space. I don't know that it's a clear one for one that's happening, but so that's why I think this is still an area of growth. What I do wonder about, and if we might be more moving into it, to me, what is more, I talked about traditional active and discretionary active or discretionary fixed income. The active ETF universe, and you guys know it quite well, includes things that are not just stock and bond oriented. They're options based. And the active management is more on the options world. And so whether that's single stock related ETFs, I can't believe we have to say single stock ETFs with a straight face, or defined outcome oriented ETFs, I think that we're going to see more. There's so much competition in that space, and it's less about the brand, perhaps, or I don't know that the brand has the same value the way that it does. People are familiar with T. Rowe Price or Capital Group or BlackRock or others as active managers, and they have confidence in it. I don't know that that's the same thing in a single stock leveraged ETF or even perhaps a defined outcome ETF. So I do think we're going to see some market share gains and losses happening in that space. I think we might have seen it a little bit this past year, but I think it's going to certainly occur as we move the next year forward. But what do you think? Do you think we're still early days?
Yeah, I think there's still a lot of managers on the mutual fund side that haven't moved over to the ETF side, and so I think it's just going to be interesting to kind of see what's going to happen. Now with the share class, and I know we'll discuss that a little bit later. But it's something to watch, and I actually do have a follow up. When you mentioned some of traditional stock picking or security selection, do you think brand is really going to play a big role in where the money goes?
So I think brand carries weight to get somebody in the door, and then performance is going to keep them inside. And so if some of the firms that have offered ETFs that had a strong mutual fund legacy have kept not only their firm brand name, but the names of the products the same. And they're either clone products or they really feel, or by name or in reality. And so I think that's going to carry a lot of weight, and they already have a track record that you can perhaps point to either of the firm or the manager. Some of the other products, again, from a discretionary standpoint, is we offer active strategies. We're now going to offer you an active ETF version of something, but we haven't really brought that to market in the mutual fund world. It may have existed in the separately managed account space. Then I think it's going to help be the brand that gets in the door, and then it's going to be whether or not you can deliver on it. And so I'm thinking, for example, Reckoner is a firm that offers CLO ETFs. They are newer to the ETF space. They've got a history, an institutional history of focusing on that space. They're gonna have to prove, and I think they can, based on their heritage, that they can prove that they can add value with active management. But that's a little bit different than, I keep going back to the same one, so I'll try somebody different. Fidelity, that has brought some of the same named products, the Fidelity bond mutual fund or total bond mutual fund. It's already established itself as a strong player. Eight close to 10-year track record.
Yeah, I'll jump in for a little bit because I thought you brought up something interesting about how we're defining active. So I think it's just important. Like this whole time, active should be in quotes, right? Because you said you have single stock, you have the stock picking, but I mean, I'll throw out some stats. Like about 85% of all the launches this year were active in some component. We now have more active ETFs than passive. Like on this concept of like overcrowdedness, like Todd, do you think that like are we overcrowded now already, or do you think there's still a lot of room? And then how do you actually like start to stand out? Like as there's more products, what actually determines which ones maybe actually are still around 5-10 years from now?
So I think we're overcrowded, and we're going to get even more overcrowded in terms of the single stock and defined outcome areas, the options-based strategy. And I say overcrowded in that it's a small pool of assets right now. So we have to, the universe of potential investors has to expand. People who are more trading oriented and that are using leverage and doing this on their own to do single stocks have to make it into the ETF world the way that we saw, Bitcoin investors make it into the ETF world. Option strategies have existed for years. I think we've seen a number of them. We're going to see more of them as the industry gets more creative. I would shout out Calamos, for example. I know you guys and your colleague Eric Balchunas has talked about the auto callable space, and Calamos was early there. That's innovation, and that's been successful. I think it's gathered over $500 million in assets. I think we're too crowded in terms of number of products, but I think there's too many mutual funds also, except the difference is those active equity mutual funds are bleeding assets and the active equity ETFs collectively are growing assets. So I think we're going to see firms that have dipped their toe into the ETF marketplace and have had some success and seen the broader industry success continue to expand. And yeah, at the risk of front running the question, when we get share classes of existing products, I think then we'll start to really feel much more crowded than we do today. Well, let me ask you, because I heard you, Ethan, on a different Bloomberg podcast, talk about something might blow up because it's a single stock leverage at some point.
Yeah, we were to your point about like the single stock crowdedness, right? So at first there was like all these several issuers were launching like the same Tesla product, so they wanted to differentiate. So they were going after these like small cap quantum stocks, and there is some stocks that have a market cap of like 100 million in a 2x levered ETF, and we tested this. I don't want to see anything blow up, but obviously we pushed the envelope into like what stocks are being put into these leverage products. So I don't think it's a non-zero possibility that one of these ETFs could liquidate in a single day, right? Just because of the moves in some of these stocks. But right, that's a different active, right? That you're talking about, that more the single stock stuff. But yeah, I think that's a good answer. Like, yeah, maybe there are a lot of ETFs, but there's a lot of mutual funds too. So I don't know, but to your point, more stuff's going to keep coming. So maybe standing out is just going to be harder.
So I want to come back to you on one stat, and apologies, I'm going to source somebody else's data. It's not even mine; it's Morningstar's data. But
how dare you?
And feel free to then edit this part out as appropriate. I'm sure your data would match this as well. But Ben Johnson posted this. I saw on LinkedIn that single stock ETFs, at least the way that Morningstar is classifying it, is 2.5% of the assets of active ETFs and 14% of the number of products. So to your point, Ethan, there's a lot of products that are out there. I think I think we've seen closures already happen. I think we're likely to see more closures in that space. Whereas let me bring it back to the majority of it, more the discretionary side of it. I think a firm like Baron Capital that just launched their first ETFs, I feel like they're in it for the longer haul. I think they're going to be committed to the space. And hopefully the products are going to be successful also. But I think it's less likely that they're going to close those products, even if they're under $100 million in the in the in this, or under $500 million, or whatever number we want to use as a point of time for success. Whereas the traders, who else? The T-Rex products, I think we're going to see many more of those come and go.
So actually something I wanted to talk about, which I think flows naturally from this, is trends. And so I know you mentioned innovation and the auto callables. And are there any active trends you think are overhyped as we head into this year?
I've moved into, so there's ETFs that I don't think we should have, and I'm not going to name them. There's just enough ETFs, and it isn't necessarily up to me to be able to do it. I guess I'm happy that I'm talking to the two Bloomberg research colleagues that I know of that are not crypto advocates.
I hope Eric listens to this.
Or zealots. I hope Eric listens to this. Yes. Happy to have it. But so I think we're going to see many. I don't think you guys, and I don't think that's considered active in this space, but there's ETFs that exist that are tied to strategies that I didn't necessarily see a value. And I'm not just naming crypto related ones.
Mm-hmm.
I think the market's going to determine that. So, for example, I was pleasantly surprised at how popular CLO ETFs. I know I just referenced one of the firms that's there, but the Janus Henderson suite of products have been tremendously successful. When they came out, I don't think I was as optimistic about how successful they would be, and I was proven wrong. I think, I think ETFs are a great access vehicle, and you can get the benefits of active, whether it's active in the security selection or active in the implementation or options or what have you. I'll let the market decide, and then we've got to opine on those from a success or lack of success standpoint. So I feel like that's a dodge of a question, or dodging of the question. But listen, we've got how many 4,000 children in this ETF space, Ethan? Because I know, David, you've got many more mutual funds that's there. I treat them all equally until I don't have to know about them anymore.
You love all the children equally.
Well, I some of them I remember their names, some of them I don't. And you come across these things, the market's going to determine whether or not. And we've seen products that came out of it came from under the radar and emerged. And so it would have been logical to say those products weren't going to survive and didn't have a case. And then the market had success. But I think that, and maybe we're going to get to it. Apologies. I know you shared an outline. Audience, I got an outline on this, but I don't have it in front of me. I think distribution is going to be key for whether or not a product is successful. Maybe I'll pause there. Maybe we don't want to go down that path.
No, I want to talk about the 4,000 plus and maybe another 4,000 coming. But obviously, a big story for 2026 can be the share class, right? What, or a conversion? So let's just say any of those routes. What kind of impact do you think the share class ruling or firms looking for conversions is going to have on just the industry or just active in general, like that part of it? Just how much more competitive can it get? What maybe types of strategies do you think are going to come through or be listed as share classes from some of these asset managers?
So I'm really intrigued to see how this is going to play out. Getting approval and then coming to market are not the same thing as you both would appreciate. And so I want to see what not only what products the asset managers come to market with, because to come to market means to convert, to take a non-transparent product and make it transparent. And so the industry has moved primarily towards offering ETFs that are fully transparent from an active standpoint. There's some success stories, and I don't want to debate that here, but there's some success stories from Fidelity and T. Rowe Price that are in smaller number of products, but have had success. But you gotta be willing to share your full book. So that's going to be strategies that makes sense to be able to do that. Primarily large cap U.S. equity strategies. That's going to be ones that have capacity to be able to not have to worry about closing. Again, good real world problem to be able to have, and where the management team is fine showing their hand. So it's a relatively low turnover. I'll go with a relatively low turnover strategy, at least out of the gate. So I think we're going to see products in 2026. I think both of you I'll see at the exchange conference in March of 2026. I have confidence that we'll have products that'll be out from dimensional funds and FM and maybe a couple other firms that have been very eager to come to market. But I'm still a little skeptical as to how fast we'll see some of the other firms that have a well-established lineup of strategies. Are they ready to bring their mutual fund client base into the ETF marketplace? Or even smaller firms. I referenced Barron Capital. They and Tweedy Brown are a couple of the firms that I saw that have gotten the next step of approval. Those are mutual fund franchises with mutual fund more oriented shareholder bases. Are they ready to bring those people into the ETF world? I think they should be, but are they set up to be able to do that? And I don't know how fast that happens. You guys, well, let me get your take. I realize this is not my job to ask you the question, but my gut is that we're going to see in the hundreds, low hundreds, maybe 100 plus or so tops products that come to market in 2026 I'm not putting a hard number on that. Do you guys have a number in mind of active share classes that come to market in the next year?
I don't think it's going to be high. I think it's going to be slow going. I think it's going to be a lot of wait and see from some of these firms just to see what happens. And one of the things last year, one of the things I was waiting on just from the mutual fund side is holding reporting was supposed to go monthly for big funds. Like it was like over $1 billion, but that got pushed another couple of years. And it just seems like the industry, there's a lot of firms that do not want to show their holdings. And so if they don't want to show their holdings monthly with like another lag, why would they want to show their holdings daily? And so I think there's still a lot of apprehension for a lot of firms. And so I think it'll be slow going in 2026. I don't know what's going to happen after that. I think it could pick up after that.
Yeah,
What about you, Ethan?
I think I agree. And maybe I'm just too cynical, but I also think the stuff they're going to roll out might not necessarily be their best stuff at first. Like if you have a really good fund that's has good star ratings, good performance, maybe that's not the one you start with. You sort of start with these other ones first that maybe have smaller assets. But obviously we're very pro ETF here, right? But Todd, is there maybe with either share classes or conversions, is there actually strategies that you think do not make sense in an ETF? Like I know everyone wants to push to go towards ETFs, but is there maybe one or even Dave, this might even be a question for you. Like where is it, hey, you don't need to be an ETF. It either because you're giving something up or because of the transparency or because of the liquidity that maybe it doesn't necessarily make sense to be in that wrapper and you should just stay as a mutual fund.
So I don't have a great answer. Again, I'm a former mutual fund analyst that became an ETF analyst and still is aware of what's going on in the mutual fund space, but not enough. But the active small cap space, we've started to see products that have come to market, but most of the products that exist in the active small cap space, and I'm going from gut, not from actual the data, I think are more in the systematic approach, the Avantis, the dimensional funds, the very broadly diversified, not taking on that much beta or taking on, trying to add that much alpha, being beta like. That feels like an insult. It's not intended as an insult, but lower cost, well diversified, holds thousands of positions and not in the below 100 positions. So if you want a concentrated small cap strategy, if you believe in stock picking from a small cap approach, mutual funds might make sense because one, that's where it exists, and two, if you are successful, then a closure can happen. That's an area that I'm going to fall back on. I'm not sure that I can come up with that. I'm going to go with that. That's the one I'm going to fall back on.
No, I would agree. I think capacity issues is kind of still the big holdup in some of the mutual funds moving to ETFs. And yeah, small caps, micro caps especially. I can't
Yeah.
imagine we'll see a ton of micro cap ETFs. And even, you talk about emerging markets, there are emerging market ETFs, but then if you start getting into even the frontier markets, I start to wonder about capacity issues there as well.
Yeah. One thing that comes to mind is like kind of on the private equity side, like we saw this XOVR ETF, right? The crossover that holds some SpaceX, but there was actually a problem that when more people came in, the weight in SpaceX got watered down. So I would think that would be a case that they wish they could maybe close the fund, right? Because the existing shareholders are getting watered down. So I don't know if maybe private assets falls in that category too. But yeah, it definitely be interesting to see. Like, but I agree. I think on the small and micro cap, I think that's maybe one strategy that they it could become a problem if they get too big.
Yeah, I mean, so in some of the even U.S. equity mutual funds, I'm pulling back from years of memory on it, but where they own private placements, obviously that's something you can't do. I don't think you can do in the ETF wrapper. You'd have to mark to market that much more daily, or NAV would be all over the place for the ETF. Um, yeah. So if you if we're thinking about it from an investor standpoint, if you as an investor believe that that's a value add that your active manager can provide, then you'd want to make sure that that was possible and it would exist in the mutual fund where it wouldn't exist from the ETF standpoint. But there are also, David, you know this better than I do. There are mutual funds that are equity mutual funds that are gathering assets that people are staying loyal to and adding money to. So that they're doing so for good reason.
Yeah. Yeah. I mean, there's definitely going to be a lot of legacy holdovers that will still find success no matter what. But as the industry as a whole, though, it's going ETFs. I did want to switch gears just a little bit. And I know you speak to advisors. So I think it would be great. This is a good question for our audience. How are our advisors actually using active ETFs today? Is it, for alpha, building blocks? What are you hearing?
So it depends upon what type of product that it is. So we work, and just as much for the audience to better understand the lens that I'm focusing on. We at VettaFi, we host virtual events with some asset management partners, speakers, and the audience are financial advisors. And we're routinely asking them questions, survey questions, poll questions, whatever you want to phrase that, during our events to get an understanding of who that audience is, what they're interested in, and help use that to help drive the overall conversation. So it depends. We've done events with a firm like Neos, for example, that offers defined outcome. They use their active management. It's on a tax efficient approach using options tied to the S&P 500 and with a product like SPYI or the NASDAQ 100 like QQQI. What they're doing is what the investors that are coming and listening to that have told us is many more of them are using an options-based product to generate enhanced income and using that as a complement or a replacement to their S&P 500 or their NASDAQ-based strategy. So that's a complement to generate income. Whereas we've hosted events with T. Rowe Price where their products are more discretionary, stock picking equity strategies. And so what they're doing is trying to outperform the S&P 500 and looking to do so with security selection. So I think that those are just two examples of use cases that we're hearing from people. It's a little hard to ask an audience that hasn't opted itself in that question. So it's somewhat self-selecting. The people who are coming to learn about options income are using options income strategies as a complement more than or to be able to generate that income. Whereas, of course, the discretionary folks are doing differently. We haven't asked the full audience because if we tried to get everybody to respond to such a question, we wouldn't get them because they weren't as engaged with us. So again, answer and maybe a bit of make sure that you know the data that you're working with.
You know, I really like that usage question. And I don't know, Todd, are you finding, let's say you mentioned Barron, right, that had come to the market through their ETFs. And I think, David, you've written a lot about this. Like, it's a good fund, right? Their strategy's been really good over time. Do you find that whether it's advisors or retail investors, are they using the active ETF properly? Meaning, are they buying it and holding it for the long term, or are they trading in and out of it and then thus maybe doing themselves a disservice if they're not committed to that strategy long term?
So I think the flows would, and not picking up, I mean, their Barron products have not been out long enough for us to use them as a full study. And I also I don't want to go off the top of my head in terms of not looking at such data. But the flows data that I've seen shows that people are using the active ETFs that are intended for longer term strategies in a longer term manner. The single stock oriented ones obviously are being traded, or hopefully they're being traded much more frequently in and out. Otherwise, people are going to get hurt. But their asset base suggests that that's the case. To me, I think people are using them the right way. I'm going to answer your question in a way that may not have been intended. What I'm a little concerned and want to make sure, not that we're going to have, maybe the audience here is going to learn as a result of this for how to properly trade an ETF. But my concern as we bring more people over from the mutual fund world into the ETF space is that trades get put in overnight and executed at the open. People are trying to do things at the close. And as you guys know, that's just not the way you should be buying and selling an ETF. Limit orders. I will be the 80th person who talks about ETF trading that uses the phrase limit orders this year, assuming 80 people have done that as he pops into his own head. But trading the right way that you should with an ETF. So I'm more concerned that people are not trading or thinking of it as a trade than more that they're trading too much.
Yeah. Well, that's actually a really good point that you brought. I've never thought about it, about, let's say, a conversion, right? If you're using a mutual fund, you're used to putting in your orders, they get executed at NAV, versus now if it converts to an ETF, there's a whole new trading dynamic, right, that you might not be used to when you're putting in your orders. So I think you gave us some research ideas that we can maybe explore.
Excellent.
Yeah, thank you for that. Yeah, that's a really great point. On this, like David did a good job of like identifying someone like Ron Barron who's like performed really well over time, but obviously beating the market is hard, right? Like we've seen the SPIVA reports, and David does a report too about it. Like just active, it's hard to beat the market over the long term. And now you have all these single stock ETFs. Do you think in a way investors might be looking at these active funds saying, hey, they can't beat the market. I have all these like leveraged single stock tools now. Maybe I'll just become the new stock picker. Like I can be Kathy Wood, and shifting that away from like the active manager decisions. Do you think that we see more of that as we see all these single stock ETFs and people just having this confidence that, hey, the market only goes up all the time. I could beat the market. I have these lever tools and I'm the new stock picker. I don't need this XYZ manager.
So yes, I think we've been in that world, whether or not the individual is fully in that world, but we've certainly seen, the growth of ETF strategists and model portfolios where they're using index-based ETFs primarily to overweight this and underweight that on a sector or a style or investment approach. To do it on a single stock leveraged approach is dangerous because you're not picking, I guess you are picking the stock, but you're also picking how much that stock is going to move in that short period of time. So in that scenario that you're talking about of using individual stock or single stock leverage ETFs as the way of trying to outperform the market and doing that on a daily basis, sure. I think that's probably that's been happening outside the ETF space of people using their brokerage account and using leverage. That scares me. I didn't know that those people existed outside of the ETF world beforehand, and I didn't know them. But now, if I know them because they're part of the ETF world, then I'm more concerned about that. I'm assuming you were talking about that scenario as opposed to somebody who's using the different sectors of the S&P 500 and overweighting based on that?
I mean, just more like, okay, the stock pickers have always been there. They can trade stocks, but now it's like, hey, like you want to buy NVIDIA, but like now you have 2x NVIDIA, and maybe you see what, let's say, Kathy Wood is holding, and I can just buy 2x versions of all these ETFs and try to just, I don't know if it's, this get rich quick mentality, or I can do better than them, and I have these tools that didn't exist 5 or so years ago, and that's what's sort of been feeding into this, like, the new stock picker. It's been being a degen, the more risk I've taken has been better off. And I don't know how this ages. Obviously the market can change, but I was more thinking just about how, not necessarily just using this leverage stuff, just how that more ETFs have gone back to, hey, you're the stock picker,
So I think if it's using broadly diversified ETFs to do it tactically, and they're very low cost, and on most platforms you can trade them commission free. Yeah, I'm for that. Even though the more you trade, the more you're likely to fail in doing trading. I think.
Yeah.
I'm more advocating for someone to take a more strategic approach and a tactical quarterly overweight this and underweight that from my mindset. But certainly people are doing that. The ETF vehicle is going to make that better for them. I think that's going better in that it's going to be easier to execute.
Yeah.
Not necessarily better in that it's like you're playing with sharp objects with single stock leverage ETFs. You have to do so carefully. I don't have confidence in my ability to be able to use such sharp objects, so I'm not using them, and I'm going to leave it to somebody else to be able to do so. I don't have confidence in my ability to necessarily do security selection anymore. I don't have the time to be able to do that. So either I would be, again, I'm not going to reveal my book, but I am doing things that's more strategic in nature, or I'll pick a couple of active managers that I have confidence in, that they have the full-time job and a team of resources to be able to do that on my behalf.
So I've got one more question before we go. You mentioned the portfolio manager. With mutual funds for years, we had star managers. And as we move into the ETF wrapper, do you think that era of the star manager is fading or evolving?
So I think it's evolving. I mean, we have some of the stars of the mutual fund world, and it's more, I feel like the names of portfolio managers, we've referenced Ron Barron, so he's an example within the equity space, but more of them are in the fixed income space. I name dropped Rick Reeder earlier, who's got a couple, I think, successful ETFs. I think I name dropped the double line guys of Gunlock and Sherman and team. I'm probably failing to name other ones, but it was interesting. I was with Jay Jacobs of BlackRock earlier this week, and he referenced the name of the manager of BAI, which is their artificial intelligence ETF, Tony Kim. And I think it was intentional that he was referencing the name of that manager, so that, and I'm sure Tony Kim has a great record and great pedigree, and the data shows how well that this fund has been performing. But I hadn't known. I don't know that the average investor would have known of Tony Kim. But this was, I think we're seeing asset managers, and I think they should lean in. If you're going to trust our security selection, you should know the name of our security selector for ETFs. And I don't know, did you guys know? I'm going to put you both on the spot. Did you know the manager? Would you know the name of a manager of an active ETF if you didn't know it beforehand in the mutual fund world?
Probably not. It's tough. There's so many.
It's hard enough to remember the 4,000 children tickers we've got to come up with, right? So the names of the portfolio managers that go with them.
Yeah, it's tough. But this was a great discussion. Todd, thank you so much for joining us.
It's a pleasure to be with you this way, and I'm excited to see both of you, I hope, at the Exchange Conference in mid-March in Las Vegas.
Great. Ethan, thank you for being my co-host on this episode. And I do want to thank our listeners. If you like the episode, please subscribe and leave a review. If you want to see more of our research on the terminal, go to BI Fund Go for fund and active research and BI ETF Go for ETF research. Until our next episode, this is David Cohne with Inside Active.
With 4imprint, finding the right promo products can be easy. They call it 4imprint certainty, which means you get free samples, expert help, art assistance, and their assurance your logo looks great. 4imprint offers thousands of options to choose from, including branded apparel, drinkware, outdoor, and more. And it's backed by their 360-degree guarantee. That's 4imprint's promise that your order will be packed with care and delivered on time. Need your order faster? 4imprint offers quick turnaround options too. Visit 4imprint.com to explore. 4imprint, for certain.